Hi, I'm sorry, but I can't give a presentation in German or Swiss German, even though I've lived in Switzerland for 18 years. In Lausanne region, my German's limited to a few phrases like Rusty Graben and such. I have a background as an engineer, then an entrepreneur, and over the last 5 years, I've been very focused on early stage investing, so seed investing or investing in startups. I'm also very actively involved with Go Beyond, Zurich-based and pan-European angel network. What I believe is there's a big opportunity in the seed funding and the startups is that value is created from nothing, and provided alongside the role for investors, alongside a bit of investment, as long as the value is created is far in excess of the investment and the percentage that the investors put in, then there is the basic idea. There is it's a good financial investment. And we're here from Mobino, where it's a typical startup. A few guys get together with an idea, and basically it provided ultimately it turns into a success. It's something that over a few years has started from an idea with very little initial value into some value created. And one of the reasons is, compared to a big company, this is data taken from an incubator, the main incubator in California, is you can have a small team where the guys are working harder, they're more focused and more productive. The organization is leaner, more able to change and adapt to find a market. Often the guys are incredibly smart. When you look at like things together like that, you can see why there's there's an opportunity there. And if you kind of look at part of the theory is in addition to the value and the investment, is over time the execution risk of achieving it needs to basically come down. If you look at an individual investment, where I said we're looking that's the theoretical sort of model. The problem is that in practice, viewed from outside, like as an investor or a customer, often you still see enormous risks in a seed or a startup. And one of the reasons is there's just so many areas where there's risks. There's risks about the founders. They may leave. They may have other personal reasons why they can't dedicate their time. Employees, reliance on key employees. The technology can involve lots of risks. There's market risk with all sorts of existing companies and new entrants. There's the risk around the intellectual property and legal risks with customers and etc. I was going to focus just to show on the technology and the market risk, why it's very complex. Is if you look at this simple matrix of the different ideas of whether you're building a low technology or a very high technology typically like an EPFL or an ETH spin-out. If there's a high technology risk and a high market risk, and something like this is Elon Musk building Teslas, electric cars, new market. I mean, we see this with something like Poken. Originally it's a very high market risk where you're trying to establish a market. Where I think there's very interesting in Switzerland is there's a lot of high technology ideas where there's a low market risk. And this is where if you can build the technology and it has clear advantages over cost, size, speed, energy consumption, then there's a low market risk. A lot of the initial founders often believe they have a low technology risk and a low market risk, whereas really, this is very, very rare. I mean, you could argue something like Facebook was a low technology because it was written in a few weekends, and it was a low market risk, basically because it was at the right place at the right time. But mainly with a low technology risk, you end up in a very competitive market. And so there's, there is an enormous amount of competition. So what can you expect as a return from seed investments? And these are the typical seed investors. I'm going to focus on angel investors because that's my background, and there is actually some data about angel investors. And this is a US survey which says, that you can get a 26%, expected return based on, being, understanding the market somewhat. There's also, a high risk is that the majority of investments don't return the money, and a fair proportion of the angels, lose a lot or all of their money. And a lot of it is skewed towards the top few exits, which provide most of the total returns. There's some European data as well, which shows similar, annual returns of 22 to 27%, and similarly focused on, a few, big returns. When you look at that, it seems to be that maybe it is an asset class, but I think we have to also understand there's very little data. It was around a few hundred angels. Most of it's US. Most of it is, it can be 10, 15-year-old data. Most of the indicators are negative, and it really relies on, a few, home runs, black swans, which gave the majority of the returns. So then the question of, do you need to be smart money to get to these returns? And within this asset class, there are returns like these guys. And were they smart? Were they lucky? And definitely people like Peter Thiel and Ram Shriram were very, very smart investors. And there is also I guess this is nearly 8-10 years ago, a group of Swiss angels who got a very, very good return with Zing, and that then went on to finance a fair few more startups in the region. You also have people who could be considered to be smart investors, like Ron Conway, where you can see if you were to name most of the Californian successes, this guy has invested in them at an early stage. So he has a lot of sector knowledge compared to someone who's further away from that ecosystem. So in my view, he has there's massive information asymmetry and massive network asymmetry. So information-wise, someone like Ron Conway, who's already invested in a social network, when the next one comes along, he can make a very, very good judgment on what's the likeliness of success. Plus, he can bring in his network to help make it a success. So this leads some of the Californian investors to say things like that it's too scary for ordinary investors. Again, too scary. that a lot of people tried and didn't succeed. And one of the other reasons around the smart angels is if you're viewing it purely as a financial investment, then you view the valuation as based on the profit or the revenue that the company is building. However, if you're able to work strategically, you can look at it as a win-win with the eventual acquirer of the business, such as medtech to a big company, or software to big software business. So because the strategic value, because of the win-win aspect, it's easier to create that strategic value than if you're relying on proving that this business is a viable business, based on its revenue. So really, that's another factor in the favor of the smart investors, is the financial exit involves far more risk to create the same value. But it can also be a disadvantage being smart, because some of the best ideas look like stupid ideas at the same time. I mean, Google is the classic one. Yahoo turned it down for $1 million valuation because they said search engines had already been done. Mm-hmm. Plus, you're dealing with kind of making investments often in a team that looks difficult to make a judgment. So if for anyone who doesn't know, this is the early Microsoft team, which obviously was a good investment back in the day. Then, whilst an individual investment's risky, there's obviously a portfolio effect of grouping together, a larger number of investments. And on the face of it, this should be the idea is this will spread the risk. But if you're dealing with a strategy which is wrong, you could be throwing more money down a bad strategy. But how do you know? Whether this is the case? How do you, if you try and diversify, again, do you diversify in a sort of random way by trying to spread your risk across different sectors, or do you try and build synergies with the investments that you're doing, which in some ways concentrates the risk? And again, this is difficult if you're not so-called smart money, which understands the markets and the types of companies that you're dealing with. Plus there's many types of portfolio strategies, whether you just throw money around, whether you specifically look for lower risk, whether you look at which sectors you understand, whether you try and think ahead of the market, or whether you focus on different elements of the business. One other feature of building a portfolio, it's not like building a portfolio in publicly traded companies where you can sit down with a financial advisor and straight away within an hour, your portfolio is there. It can take a long time to build that portfolio, because if you were focusing on startups in Switzerland, it could take a couple of years or more to build out a portfolio that with companies that you like. And also this kind of one feature of this is it becomes a bit opportunistic, because you have to take the opportunities as they come along. You can't do it in an extremely structured way. Also, it's very, very difficult, if not impossible, to do it just by watching. You need to jump in, and the challenge is you need to make sure you've invested enough into a particular business that it's worthwhile for you to take an active interest in it. Otherwise, just based on the return, it's not worth your while to put the effort of the time in. Then there's a question of whether Switzerland is a different, ecosystem, because so far we're not dealing with a country where Googles and Facebooks and businesses like that are being created. It's a far more kind of stable ecosystem. One thing there is a lot of screening and support for emerging startups. The CTI provides a lot of support. There's venture kick and startup competitions. There's also no fail fast culture, whereas in the US, the majority of startups have failed within a couple of years. In Switzerland, it's maybe 90%, will carry on after 5 years. I think that's figures from the ETH spin-outs. But going back to the graph I showed before, where there's a high market risk, often to create businesses in that sector are very difficult here. And that's where we see the successful ones are encouraged for a number of reasons to go to San Francisco or London or Berlin, because of that network advantage in those cities. I think from the business angel perspective, we see there's less smart money in Switzerland. So the equivalents of the Ron Conway type investors, are very few and far between, which means there is more access to the best deals. And I think with the presentations this afternoon from the crowdfunding platforms, is one way to access. And a lot of the deals that are available on those platforms are the same deals that the business angels, are very interested in. And if the business angels, consider themselves the, part of the smart money, that's clearly that it's, there's more access to it. But it's still very difficult to spot those deals. In one group of these startups are the spin-outs from the two main technical, universities, and there is figures. There's a lot of reports and researchers have studied these spin-outs, and the latest report shows that it's a good investment, and there's a good return from these spin-outs. But whether it's actually an asset class, whether you could group all of these spin-outs together as an asset class, whether you could look at the ones which have received the CTI label or the ones that have been supported by venture kick, it's still it looks like the previous slide showed there's a good investment, but the reality is nobody so far has created a fund which has just tried to invest in every single spin-out or every single CTI label business. So I think it's far more complex than it might look. There's also, it's very difficult to know how many of these really good investments there are, and we as Go Beyond Angels, we clearly see and we clearly invest in 2, 3, maybe 4 a year. But what's unclear to myself or any of the other people I talk with is, are there a much larger number of very investable startups? And are they there? But is it just limited because there's not enough smart money, there's not enough available money, including grants and things, there's not enough ambitious entrepreneurs, or because something in the ecosystem, blocks them from scaling. Whether it relates to the, Switzerland being a small country. You're comparing to the US-based startups who can address, a few hundred million market, whereas, Switzerland's, maybe even 1/100th of the size of that. So there's a lot of extra effort to go international at an earlier stage that, startups in the US or in China, don't need to do. And then is the ecosystem, anywhere the ecosystem is never really complete. But in Switzerland, the ecosystem lacks, a few things. And one of the areas, I think, is the supply of smart investors. Also, the tax and legal situation is quite complex. And the whole legal framework isn't really designed for startups. Typically, these are companies that make losses for a large number of years, want to be agile and to be able to restructure quickly, and also want to offer share options to employees who could be in many different cantons or countries. So alongside the concept of smart money, there's also the concept of supportive money. Smart money could just be the guy who says, this is a smart investment, but invests and doesn't help support the business as the business grows. But it go beyond, and from my own experience and others, we see that it's not about making an initial investment, but that the startups need massive support along the way when they reach critical stages over the strategy, kind of ongoing financing, any restructuring of the business to get to the market, or making key hires. And it's also about making the right high-level introductions at the right time can make a very big difference to the success or failure of a startup. And these are some of the things that supportive investors can bring to the business, which is based on having a lot of relevant knowledge, and often having done things before and seen the problems that can arise. And it's not just about saying yes all the time. It's also about being critical, being upset when the things are not going, not being done correctly, but also being supportive and being responsive in order to help quickly when startups need quick response. However, currently the Swiss ecosystem doesn't really reward supportive hands-on investors. So one of the problems is there's little recognition, is that the CTI provides a lot of support for free, which kind of leads a culture that startups rely purely on the stuff that's coming in free, and they expect people to continue to help them for free. Plus, there's no high-profile accelerators in Switzerland, generally because the startups are very diverse. There isn't the equivalent of Y Combinator, Seed Camp, or Startup Boot Camp like we find in Berlin, London, and Silicon Valley. Plus, if you're a hands-on investor, there's a sliding scale of being a passive investor, where you're clearly not classified as from a tax perspective as a professional investor. Whereas if you're classified as a professional investor, then the gains that you make from capital are taxed as income, which is in Switzerland is very bipolar, either 0% or 45 plus social charges type of tax. Very, very strange situation. Yep. And a lot of the co-investing from the crowdfunding and also from the co-investing funds like ZKB and Swisscom Ventures and others, is focused on the investment, and then figuring out the ongoing support as we go along. So, because I say the smart and supportive money is important. In order for other people to come along and invest, they need to connect together with this money. The old-fashioned way was investing through a venture capitalist, and the venture capitalist had a fee structure, like this. So venture capitalist is taking, quite a large percentage of the investment. Via the internet with platforms like AngelList or with angel clubs, it's possible to get along with deals with paying little or no fee. Usually there is an investor who's the lead investor will go onto the board of the company as a director, and he's often rewarded with some share options. But very much it's a supply and demand thing, and because there is little amount of smart money in Switzerland, there is this opportunity for other investors to invest in the same deals on pretty much the same terms as the experienced investors. But it's a supply and demand, and if there's it will change if there's more or less experienced investors. So there I think it is possible for anyone to get to those deals, and but one of the issues that it creates is with having more investors involved in the company, it creates more management of those investors. Again, the crowdfunding platforms have tools in place to help manage this, and I'm sure we'll hear about them. Also, the co-investing funds and lead funds, such as Debiofarm. Debiofarm recently invested in Your Turn, nearly 3 million francs. So they've gone from being a small seed investor to a much larger. And this is, almost every 6 months we're seeing the landscape change because of the entrance of these investors. One of the keys, if not the key thing in all of this, is being able to exit these investments, because they're not liquid by definition. One of the fundamental problems with this, and these are not exact figures and relates to a period of 10 years, probably a few years ago, is that in the US there's far more exits of venture capital backed businesses, so including ones that started off as seed investments, and that's because of the giants of Microsoft, AOL, Google, Facebook, Apple have made between 200 and 300 billion of exits of purchases of smaller companies with technology they wanted to incorporate, whereas in Europe it's a far more smaller ecosystem, so it's far more difficult to exit a lot of businesses. From the liquidity in general, it takes a long time from the seed investment to exit. And this can be 6 or even up to 10 years or more. And if VCs are involved, usually they want to grow the companies for a longer time. So it can become more complex and longer. In the US, there's a very serious attempt to create a liquidity market for startups. And this is called secondmarket.com. But it's very much restricted to the high-profile startups. There's also a tradable fund worth about, I think, $160 million that has investments in companies like Twitter. As go beyond, one of the things we want to offer is a path to liquidity. And also some of the crowdfunding initiatives are thinking about this liquidity. But overall, these companies, these seed companies they have a lot of risk. There's a lot of risk areas in them, even once they've advanced quite a way. So really the liquidity question is very complex, and it really needs to be packaged and sold to investors. It's very difficult for it to be a very simple market like for normal equities. Okay, so this is my summary. I've gone through a lot of information and shown a lot of slides, but really this is the summary slide, which shows that really today a lot of the focus is on the funding of seed investments, whereas really in order to be able to understand the risk and to be sure the value is created optimally, there's a need to be very smart throughout the process, and to deal with an exit at the end of this. One of the things I'm doing, because there are some reports which offer a kind of a global view, like the report on the spinouts, showing the ETH spinouts showing a 20 to 25% IRR. One of the things I think it's very specific on individual sectors and individual startups. And one of the things I'm doing is I've blog at hightechfondu.com in order to try and understand the opportunity and to try and understand whether what we thought would go beyond the number of very interesting startups is limited to a few a year, or whether there's a much bigger opportunity. And I think it's not really possible to do this with figures in general, but to try and to talk to the opinion leaders. And this is my initiative, so I can get a better feeling on what is the real opportunity here.
Thank you very much.
Right. Okay.
Are there any questions to the presentation?
Hello, this is Jean-François of Mobino. You talk a lot about the difficulties both for entrepreneurs and for investors in Switzerland to do business and to reach success. Can you say a few things about the good points of Switzerland? Because I believe there are quite a few.
Yeah, I mean, I believe there is a massive opportunity. I think there is a lot of startups which are not being exploited, correctly to get to a big size. I mean, as an angel investor, I've made the majority of my investments in Swiss, technologies. I think the software, kind of internet software is a bit of a difficult area. But if you look at things like traditionally it was the medtech, but I think with things like hardware, with micro nano technology, there's an incredible support system. I mean, you see this at EPF with the EPFL spinouts. There's there's a lot of these hardware companies have access through the CTI and the EPFL to equipment that if they were doing research in Intel, they wouldn't have the same level of access to the clean rooms. And there's almost no other ecosystem worldwide, you know, who has the same access, you know, to that. So there is a very good opportunity. Yeah.
Thank you. Other questions?
Hi, Tuomas Toivonen from Holvi. We're a company based in Helsinki, Finland, but we've from the start really built the company to be a European company. So even though we have Nordic roots, we spend a lot of time in Berlin, we spend a lot of time in London, other European cities. We have employees in 3 different countries. We have investors from all around Europe. We're part of Seed Camp, so that has like a strong UK linkage. So you spoke a lot about like the ecosystem here in Switzerland, but I mean, is that the key thing, or is the key thing really to build European companies? I mean, you can have your start and your base somewhere, but really you need to be a European company and then really go global.
Yeah, I mean, one of the problems with Europe at the moment is nobody's building big technology businesses. There's a lot of startups, but somewhere, if you take there's no Apple, Google, Facebook, you know, really large tech company being built in Europe. With this kind of pan-European ecosystem, one of the strange things is Switzerland is generally not included in those ecosystems. And when I've asked people about this, one of the answers to that is when you look down the list of countries which need help, you know, Switzerland's the last on the list. No one's ever, you know, suggested trying to help Switzerland, you know. So it's kind of it's basically a nice problem for Switzerland, you know. That's it. Yeah.
Thank you.